Mihir Vora is joining us to discuss more. Mihir, what's your take on, especially the way one-sided fall is coming and right ahead of the all-important Fed meet? What's your outlook on risky assets right now?
Hi Ajay, you caught me at a particular point when the market's almost at a month low or a few months low. Uh, so it's obviously mostly due to global factors. While they did manage to temporarily solve the problem of Credit Suisse, there is still the issue with the regional banks in the U.S. Reports suggest that there are some more banks which are, in spite of the fact that deposits have been guaranteed, there is some stress out there. So lots of moving parts on the global banking system. And we have seen in 2008, and probably that's very important. Markets have a memory. And we did see that in 2008 when Bear Stearns went down, that was in March 2008. And JP Morgan did manage to, buy it out, and the Fed and the government out there managed to, solve that problem temporarily. But then we know what happened 6 months down the line, 5 months down the line. So I think people are still waiting and watching. It's a risk off mode. Uh, One problem solved does not mean that the entire picture is in front of us. So I would say this risk off mindset is bearing on people's minds, especially the global fund managers. Local economy is doing well, and the other thing that is very stark is that FII shorts in India are at record highs. So and typically, and on a day like Friday when the markets actually jerked up a bit, quite significantly, FIs would have covered their shorts. But the fact that they kept on holding to the shorts and probably added to the shorts on Friday also means that the mindset is a bit negative. It's a risk-off environment as of now.
Mihir, if we look at beyond the 3 to 6 month picture, 1 year picture, how's the quality of earnings looking for India? I want to understand how resilient is corporate India right now.
So if you look at the a big chunk of earnings which comes from banking, that looks very robust. On the consumption side, also things are not too bad. On infrastructure, again, earnings are quite visible. It's on the global cyclicals like metals, energy, oil and gas, where there might be some uncertainties, and IT. So I think, broadly speaking, I would not see major downgrades to Indian earnings. But in a risk-off environments, it's typically first the multiples that get compressed, and then if things pan out as badly as expected, then probably earnings cuts would follow. But as of now, we are not, downgrading our estimates for India in any meaningful way.
Okay, and how are you assessing the valuations after this fall? Do you think we are coming in an attractive zone, or do you see some more scope for compression?
No, certainly, valuations are becoming attractive. In fact, the largest chunk, as we keep referring to the financial services chunk, is trading at valuations which are below pre-COVID levels. So to that extent, there are pockets of value in large chunks of the market. It's just a question of liquidity.
So if one were to take 2 to 3 year view, do you expect positive returns, possibility of positive returns from this market? Because last 1 year, 1.5 year, the returns now have completely got evaporated.
Certainly, with a 2 to 3 years time frame, one can expect positive returns, even if there is a correction in the market, because we have seen that this correction is because of global factors, and global central banks have time and again proved that when push comes to shove, when the markets are on the brink, they will again use the liquidity spigot. They will use whatever means to stabilize the financial markets, because it's not so apparent in India, but globally, especially in the Western world, there is a huge correlation between the wealth effect, consumption, asset prices, and the stock market. So if the stock market and the bond markets are not stabilized, then they have a major problem, much bigger problem than in India. So my guess is that already the central banks and governments have blinked, backstopping uh, almost, hundreds of billions of dollars of deposits of the regional banks in the US is not really one would expect, unless there was a real panic out there. So I think they are reacting, and the hawkishness that we were expecting 1 week ago or 10 days ago from central banks is probably not likely to happen. They will have to treat the markets with kid gloves, and that basically means more liquidity coming in, if not now then tomorrow, which means good things for growth economies like India.
How much probability would you assign that this Fed meet there will be a change in stance towards softening of stance. How serious is the situation globally, and Fed will be caught in a corner in your view?
I think we are way beyond that. The developments of the last 7 days, it won't even matter even if the Fed hikes by 25 basis points, because markets know that they'll come and stabilize if there's any disruption. So I think this debate about 50, 25 or zero is actually much less important now as it was 1 week back.
Mihir, I want to understand what do you make of the softening of yields globally? Almost everywhere yields are coming down. Crude oil has fallen to $70. What exactly is being priced in for global growth? Are people or the bond market or even the commodity market expecting a complete stalling of growth? What exactly is going on?
So even before the Credit Suisse episode over the weekend, two or three houses had cut global growth projections by almost 0.25 to 0.5%. So to that extent, markets are telling you that there is a slowdown coming, and which means that interest rates cannot stay high for too long. So a global slowdown is definitely being priced into the markets, both equity markets as well as the bond markets.
So basically, this is a good time to accumulate Indian stocks which have much superior earnings quality and the global macros, because crude oil falling also helps us. If one were to look beyond 3 to 6 months, then the chances of a good portfolio construction is a good time in your view.
Oh, absolutely. Because we are still net importers in a big way. Our trade deficit was running high because of oil and commodity prices. So it is definitely beneficial for us in terms of inflation, in terms of currency, in terms of the trade deficit, and also the fiscal deficit. So lower commodity prices, especially oil, is a huge tailwind for India.
So Mihir, also I wanted to understand from you, how are you looking the valuation and opportunity in the broader market? The mid to small cap indices actually started falling way ahead of benchmarks, and if you look beyond the benchmark, the correction over there in mid and small have been 30-40%, so much more exaggerated. What are your thoughts there? Is it a good time to start cherry picking there?
Definitely, because the advantage of mid and small caps is that there are so many sectors where a lot of work is happening. Let's take the example of, say, defense or chemicals or textiles or sugar, ethanol kind of plays. A lot of the strategic initiatives that the government is taking in, that the private sector is going towards, even real estate, there's hardly any representation in the large indices. So a lot of the initiatives which are focus areas for the government, where a lot of spending is happening, railways, roads, etc., are not represented in the larger benchmarks. The reason why small caps and mid caps fall faster in a rising interest rate scenario is that typically they are more leveraged than the large cap corporates, and the borrowing costs going up hurts them more, because interest cost as a percentage of say PBT is much higher for the small and mid cap. So we saw a tightening cycle over the last 12 months in India as well as globally. So market was pricing in earnings earnings set downgrades for mid and small cap because of rising interest costs. But now it looks like the worst of that is past us. And as you rightly mentioned, a lot of stocks have corrected 20, 30, 40%, which makes it a good time to start building in, the valuation attractiveness, as well as the fact that interest cost increase may not happen as sharply as feared.
Right. All right, Mihir, we'll let you go on that one. Thanks so much for joining us.